You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose. Let me fix myself up here, and welcome to Masters in Trading Live. At Masters in Trading Live, I get on here every day the market's open, 11 a.m. Eastern Time, go over the market, share some thoughts. Once in a while, we'll share our trade of the day. Today, we're going to talk about stops. It's a controversial subject. It's a controversial subject that I found out, but using equities, using futures, trading with stops, there's nothing more important than your trading account. Without a doubt, the priority for traders is your trading account. Protect your trading account at all time. But when we talk about stops, and especially in options trading, I don't like to use stops. But I'm going to explain to you and walk you through exactly why we don't use stops when we're buying options. When you're buying options, you have a fixed amount of risk. So before you get into that trade, I want you to consider how much you want to risk. So if you're comfortable risking $1,000 on an option trade, you can jump in there and risk $1,000. Hold that trade till expiration. It's got a binary outcome. Either you'll win or you'll lose $1,000. But what we don't want to do is have a risk parameter in mind that, okay, I want to do this trade. I'm going to risk 1,000, but I only want to lose 500. Now, you can do that in extremely liquid equities, but doing that in options is not very practical. So that's what I want to explain to you today, and I'm going to walk you through that. I also have the questions up. Thank you guys all for joining. Too many on here to go through them all, but thank you guys. I really appreciate everybody hanging out with me. Let's go over to the slide deck, and I'll keep the questions up. We'll answer each question as they come up. Let's do something different though, guys. Let's speculate a little bit on the long-term direction of the market. Once I get into stops, I'll go over the comments as well. So Qs. Okay, here's something that you guys don't see me do very often, but I decided to do it. I'm going to draw lots and lots of trend lines. These kind of charts we see all over Twitter. What's most important when you do trend line charts like this is you have to go from each point. What too many people do is literally they'll just do it from here to here, and they'll just say it looks like this rather than going back and draw lots and lots of lines. So what does this tell me? This tells me there's definitely some coiling going on here. Will the QQQs trade up to here and get rejected? Potentially. Something to watch out for. That's definitely very, very strong and can be coiling. We can also look at the small caps. Here's what the small caps look like. Here I'm looking at a daily chart. And here I'm looking at a weekly chart. The high last 3 weeks in the IWM is exactly the same. So if I pull up a live IWM chart right here, which is the small caps, I'll put it on a weekly. And here you can see, this is so important. Notice how the weekly highs are the exact same. Your line in the sand is going to be this level right here, 230.5. Underneath that level, a little bit bearish. Over that level, bullish. That's going to be a key point going into tomorrow's unemployment. Always look at your daily highs and your daily lows. All right, now we're going to talk about stops. Steve, I see your question or comment. Stops can potentially turn a current loss from beginning a winner or a big winner, okay? Great question in our Discord community yesterday. Do you recommend setting closing stop loss orders on our option trades when we're first placed? What percentage stop loss of a trade? So Kevin jumps in there. Trades are held until expiration. Obviously, you can do whatever you want, but overall, trades are held until expiration when we share them. Let me explain why. Here's a stock. And this stock is the 4Us. It's a uranium company. Now, let's say we wanted to buy the 6s, okay? We buy 10 for $300, okay? Well, right now, if we stopped ourselves out, we'd have to sell 10 at 250, right? Because we buy and then we'd have to sell. So right away, you're losing 10%. And this isn't even talking about commissions. This is just transaction cost from the bid to the offer. That is death for option traders. You would never have a stop on a 30-cent option. You just wouldn't do it. Anybody who tells you you should have a stop on a cheap option, run away. They have no clue what they're talking about. Let me walk you through another example. Two stocks. One on the left is Applied Optoelectron. Here's a name that we trade. I talked about this name yesterday. Let's look at the 45 strike. The 45 strike is $2 bid at $2.40. Okay? Now look at this guy. This is Apple. Big company. This is the one that Forrest Gump invested in. Did so well. Let's look at the 245s. 281 at 284. Notice the difference between those two? AAOI. There's more edge. Better trade for retail traders. But you could buy for 240 and you can get out for 200. That's a 20% loss just on execution cost. Now, if we were trading Apple, yeah, you can get in for 284, you can get out for 281. No big deal, right? But at Masters in Trading, we are not trading Apple, we're not trading Amazon, we're not trading NVIDIA. Instead, we're looking for opportunity off the beaten path. And oftentimes, the best opportunity is going to be in a name like AAOI or UUUU, and not in the most actively traded names like Microsoft or Apple or NVIDIA. Does that make sense, guys? The reason that we don't use stops is not because we're some crazy traders who want to take a whole bunch of risk. That's not the reason. The reason that we don't use stops is because it's purely money management. Again, 45s. If we want to buy those for $2.40, $240, right? The thought is there's 43 days until expiry. And we want to hold until we can make a big fat profit or until we lose our principal. Okay? I can't stress the importance of this enough. The last thing that you want to do in this example is buy for $2.40 and think that you could potentially sell for $1.40 using a stop, thinking that you'll only lose 50% on this position. It is absolutely impossible. I don't want you to do it. I believe in this so much. This is exactly what we've been teaching since 2015. One more example, ENVX. ENVX is a good trade. Let me show you what the chart looks like. It's a speculative biotech that's traded between like 18 and 7. I think. Let's look 90 days just so you guys can get a feel for the movement of a stock like this. Another stock that we've been trading that we follow. Here's what it looks like. Volatile, right? Traded 7, traded 16, traded 10, back up to 12 or back up to 13. Here's an example of if you're going to do an option trade, it's a binary outcome. So look, ENVX, 43 days until expiration. The stock's at 1236. Let's say you wanted to make a bet that the stock trades over 17. Well, look at this. It's 51 cents at 73 cents, right? You can buy 10 of them for $510, you can buy 10 of them for $730, or you could sell for $510. That's like a 50% loss just if you stopped yourself out at the market. If you want to buy these for 73 cents, hold, be patient, be confident, and don't stop yourself out. That'll get you in so much trouble. This is certainly one of the most important lessons that I could teach any kind of trader. Now, let's talk about futures. And instead of futures, you could talk about stocks. Kind of the same thing. Here's the ES futures, the S&P futures, and here's the ES futures as well. Here's the price on this side. Now, somebody could potentially buy the S&Ps and then say if it gets down here, stop themselves out, right? A risk-reward trade. Fine. What I like to do is if I take you down here, instead of charting the S&P based upon the price, we chart it based upon the profit and loss. So the other thing that you can do with futures is say you can buy an S&P and you can stop yourself out saying, okay, I want to stop myself out only losing $2,500 on a one lot or only losing $1,500 on a one lot. Futures is very different than trading options with just pure binary outcomes. I got to tell you, this is a topic that I am passionate about. When you're buying options, don't use a stop. If you're risking $1,000 and you only want to lose $500, trade smaller. There is no second place in option trading. They're binary outcomes for buyers. For everybody in our All Access, you guys don't go anywhere. For everybody else, thanks so much for watching. We'll be back tomorrow, 11 a.m. Eastern time. All right, guys, we'll see you tomorrow.